In 1971, Hard Rock Cafe began as a single London restaurant. Today, Hard Rock International is a global phenomenon with 121 high-energy Hard Rock cafes, 11 hotels and casinos, and 2 standalone casinos in more than 41 different countries. Beginning with an Eric Clapton guitar, Hard Rock has created the world's largest collection of music memorabilia, which it displays at its locations around the globe. Hard Rock is also known for its collectible fashion and music-related merchandise, Hard Rock live performance venues, and an award-winning website. The Hard Rock phenomenon continues to grow. New cafes are opening across the globe in cities like Bangkok, Thailand, Oslo, Norway, Caracas, Venezuela, Hurghada, Egypt, and Louisville, Kentucky. Hard Rock International is also creating a totally new concept, a rock and roll theme park that is scheduled to open in Myrtle Beach, South Carolina in 2008. Financing all this growth requires high levels of capital investment. So, Hard Rock International uses disciplined capital investment decision-making to manage its investments wisely. For example, here's how the company decides whether to invest in opening a new cafe.
Depending on the country and depending on the costs prevalent in that particular country and that particular economy, it can cost anywhere from $2 to $10 million to build, open, and operate a Hard Rock Cafe. One of the difficulties in standardizing any kind of business model in our business is obviously geographic and economic differences, which are substantial. And these are the kind of things that we have to look at very, very carefully and very closely when we look at overseas markets. Obviously, construction costs vary phenomenally from country to country. Labor costs vary substantially. Rent varies substantially. In some European locations, for example, if you want to pick a prime location in a major Italian or Spanish city, for example, you will probably have to pay a premium to that landlord in order to secure that space. That's a capital investment that you may or may not get back.
For this reason, when Hard Rock estimates the cost of building a new cafe, they get as specific as possible at the local level. For one proposed cafe, the cost estimate might include items such as $48,000 for permits, licenses, and utility connections, $400,000 for kitchen and bar equipment, $175,000 for an audiovisual and performance system, $75,000 for point-of-sale computers, and $4 million for general construction. The total capital investment for this proposed cafe is $6,010,000. Now that Hard Rock knows how much the new cafe will cost, the next step is to project cash flow. Projecting cash flow for the new location, however, involves much more uncertainty than estimating the expense of building it.
Our business is made up of different smaller businesses grouped together. Obviously, we're a restaurant, first and foremost. We also have a bar business, which is important, and we also have a merchandise business. So those are our 3 main avenues of income. However, the percentage that those income streams contribute to the total can vary substantially.
The first step in projecting cash flow is projecting sales. Hard Rock begins by looking at sales from existing cafes that are similar to the proposed cafe in size and location. Then they evaluate local factors that might influence how much money the new cafe will generate. These factors may include demographics, economic conditions, competition, the presence of other Hard Rock cafes, and local awareness of the Hard Rock brand. After taking all these factors into account, Hard Rock makes 2 sets of sales projections, a likely outcome and a worst-case scenario. Next, sales are broken out into 3 primary revenue categories: food and beverage sales, bar sales, and merchandise sales. It's important to break out sales in this way because each revenue stream has a different cost structure for labor and materials. Once the sales projections are complete, Hard Rock estimates annual expenses for the new cafe. Local factors influence many costs, including cost of goods, wages, advertising, and overhead. Finally, Hard Rock calculates cash flows for the proposed cafe. Cost of sales, labor, operating expenses, and taxes are subtracted from projected sales. Adjustments are made for depreciation and other factors. Hard Rock now has two projected cash flow scenarios, a likely outcome and worst case. With these figures in hand, Hard Rock can compute the payback period for the proposed new cafe. The likely outcome for this cafe is that it will take 3.9 years to recover the company's $6,010,000 investment. The worst case is that payback will take 4.9 years. Are these payback periods within Hard Rock's corporate guidelines?
In general terms, yeah. I mean, we look to get a payback on our investment over not too long a period. You know, if it's 5 or 6 years, that's probably too long. If it's 2 or 3 years, that's probably very comfortable for us. So we look at those things closely, and we balance the risks and rewards.
Hard Rock uses these same figures to compute the net present value and internal rate of return of the proposed cafe. At Hard Rock's hurdle rate, their internal required rate of return, the likely outcome has a net present value of $2,557,000. The worst case has a net present value of $689,000. In both cases, the NPV is greater than zero. That means that projected financial returns exceed the company's investment criteria. With a project life of 15 plus years, the cafe's internal rate of return has a likely outcome of 26.4%. The worst case internal rate of return is 18.2%. Again, these figures exceed Hard Rock's investment criteria, making the proposed cafe an attractive investment opportunity. Hard Rock International will probably give this project a green light. Somewhere soon, there will be a guitar-smashing ceremony to mark the opening of another new Hard Rock Cafe. When Hard Rock International evaluates new cafes, the company can draw on decades of experience managing cafe costs and cash flows. But Hard Rock is about to embark on a totally new venture, a groundbreaking, one-of-a-kind rock and roll theme park. This $400 million venture will feature more than 40 attractions, live shows, roller coasters, children's play areas, restaurants, cafes, and retail stores. How did Hard Rock develop the estimates and projections it needed to evaluate such a large and unique investment?
Over the last 3 or 4 years, we've developed a plan and signed a deal to do a Hard Rock Park in Myrtle Beach. In South Carolina. People go there for long periods of time. They actually have an average length of stay in Myrtle Beach that's longer than Orlando. So looking at all of this and looking at a particular location that became available, we have decided to go forward with Hard Rock Park, which will be a $400 million rock and roll park. It is the single largest leisure development in the state's history. It is capital intensive, but it has also basically been financed by third-party investors outside of the Hard Rock brand. This is a method that is obviously very attractive to us because it requires minimal capital investment on our part, but doesn't reduce our risk from a brand perspective. Obviously, we have to be completely and totally satisfied that the product that's being built and will be developed is to our standards and is going to blow people away.
Whether the investment is $6 million or $400 million, Hard Rock International uses industry experience and expertise to make smart capital investment decisions.